first rates will just start coming up on your screen. I'm going to load it up by looking at my Bloomberg screen as well, and there you go. Okay. First rates, Nifty 52 points higher. For the Sensex, it's again a flat start with no particular bias. Mid-cap indices and small-cap indices are again off to a okay start. Let's look at some newsmakers here, and the newsmaker in a sense was Info Edge yesterday. The newsmaker today would again be Grasim and iShares ahead of numbers, so Info Edge has stabilized. Zee Entertainment reacting to numbers 215. It's such a beaten down stock that nobody owns it now, frankly, so the earnings impact would not be there. Nykaa, bit of a yes and no there, but Nykaa I think has been on the receiving end, especially after the fiasco which was created when the bonus shares and the anchor share and that whole issue caused a lot of heartburn for long-term investors. But the breadth today I think is looking perfect. That is something which is really worth mentioning. Banks are off to a good start. Remember, banks were on the receiving end last time. Yesterday. So State Bank of India is off to a great start. SBI is off to ICICI Bank is off to a good start, and even HDFC Bank is off to a great start. So do these banks, are they turning around? And if they turn around, we could be in for a decent day of trade. But for the moment, it's a flat start with a positive bias.
Okay, let's find out some of the other newsmakers then in today's trading session. It's been a disappointing number when it comes for something like a Zee Entertainment that we highlighted. You've also got something like a PFC, which is in the spotlight, and that's largely on the back of the asset quality improving. Ratna Money Metals, another result reaction. A quick check-in on that stock. As you've seen, the margins as well improve. There's been an IRB infra. The total toll collections have risen about 33% on year. Linde India as well, there's been a margin improvement. Castrol, another result reaction. And you've got a Polyplex as well that has been in the spotlight on the back of numbers. All cargo logistics as well, margins have slipped. Jindal Worldwide, it's been a disappointing number. Sri Renuka Sugars as well, watch out for that candidate in trade. It's going to be in the spotlight on the back of its numbers, down in today's trading session. Krishna Diagnostics as well, the overall business, core business, has declined about 3.8% on a Q-on-Q basis, and that stock as well down in trade. Global Health, another one that's put out a disappointing set of numbers. Coforge as well in the spotlight. Do remember, barring PE, selling about 9.8% stake at a price of about 4,050 rupees per share. That's stock quoting higher by about 0.5%. And there's GSPL as well, that's in the news on the back of its numbers. But clearly seeing a hammering on the back of earnings when it comes to all cargo. That's a double-digit gash that you're witnessing in the stock. Let's get in those first trades going then from our market experts. And Jay, what is it that you're spotting on the screen this morning? Take it across to Naresh in the meantime. And Naresh, your first trade and anything that you're observing on the index, or just another boring, lackluster, dull day of trade?
So still a boring day, but NTPC is something which I continue to like. So that is where I'm adding more positions. Would be looking at adding more above 170 levels. Clearly an outperformer in the near term, expecting it to break out in the next few sessions.
Those are the first trades coming in from Naresh, but for Jay, the first trade is actually buying TVS Motor. So after that solid run-up that we have seen in 2022, Jay believes that TVS Motor could be one of those candidates which could yield good results as far as that stock is concerned, and that comes as a buy recommendation coming in from Jay Thakkar this morning.
It gives me great pleasure now to bring on board Jim Rogers to talk about what he makes of the market right now. And there you go, you can see him live on television, all getting ready. Good morning, sir. How you been?
Good morning. I'm fine. Thank you very much. Happy New Year.
So what's keeping you busy this year?
So far, not much. I'm basically watching. What I am watching mainly is there's so many people who are pessimistic and so many people who expect a recession. When everybody knows something is going to happen, it usually does not happen. So I'm trying to figure out the best way to play that. I suspect the markets, including India, including America, will go up more than we expect for a while because everybody knows a recession is here. Maybe it's not.
Okay. So now you've told us what you're watching. Tell us what you are buying and what you're selling.
Well, I'm not buying anything, as a matter of fact. I too was swept away with, like everybody else, expecting bad times to come this year. I know bad times will come sometime in the next few weeks, months. So I basically did nothing for a while, and now I'm sitting here saying, I regret it. I mean, I own commodities, as you know. I own gold and silver. I haven't bought any, but I own it. But I'm watching. I made the same mistake that a lot of people made.
A very basic question on gold. Gold is supposed to be a hedge against inflation. Gold is supposed to outperform because if inflation goes higher, it protects your purchasing power. But the conundrum is that gold in last 3 years has done precious little. Why is gold not keeping up to its reputation of being an inflation hedge suddenly?
Well, I know that what is supposed to happen is another one of those cases of what everybody knows doesn't happen. Yes, gold has often been an inflation hedge, but many times, as you know, I'm sure you watch ET now, many times gold has done badly no matter what's going on in the world. So, I mean, I wish life were so simple.
Okay, so that's the take coming in. I'm guessing that perhaps people must be buying more gold when it comes to the Valentine's Day gift as well. Jim?
Valentine's Day gift, Anisha, that's a new one for me. I've heard people buying roses on Valentine's Day. You actually
Let's
get gold.
up the game. I'm just
No, you got gold
leaving
on
small
Valentine's
hints.
Day, Anisha. I'm just curious. That's
I'm
the first one I've
small
heard.
hints that perhaps it's not a diamond, gold this time. Let's see what I really get. But Jim, if you had to buy something, what would that be?
Well, if I had to buy something, I'd buy silver. Silver is much cheaper than gold on a historic basis. But I did send my wife flowers today and my daughter's flowers. So I bought flowers and maybe some silver. Here's some silver in my pocket.
In your pocket, so you have it handy, and that's a sweet gesture, Jim. But clearly not seeing any love. I know you were talking about all that pessimism, and perhaps back home as well, we're discussing a lot of factors like inflation, maybe not recession back home. But what is it that you're expecting is going to be the next big trigger in terms of what is going to be that asset class really that is likely to outperform down the line? What do you believe one should do when it comes to diversification in their portfolio?
Well, I would say probably Japan, probably China right now, because both of those markets are still down from their historic highs. Maybe India. I mean, India's been a strong market for years, as you know. Somebody's done a very good job in India, but I would suspect Japan or China would be a better place to diversify.
Diversification is the name of the game. But Jim, what about the dollar? Of course, from that 115 level, we had seen the dollar index reverse quite a bit, but it's been quite sticky around that 103 zone. Do you see a bit of a correction here, or is it likely to head higher?
Well, first of all, no, diversification is not something I am keen on. Diversification is something that brokers thought up so that they don't get sued. If you want to be successful, you don't diversify. You focus, you focus, you focus. You have to be right. If you're wrong, you're going to go broke. But if you want to be rich, you have to focus narrowly in the right things. So please, I know everybody talks about diversification, but I'm not going to talk about diversification. As far as the dollar, I own U.S. dollars. I expect the dollars to go higher before this is over. Because when we have turmoil again, everybody's going to look for a safe haven, and they think the U.S. dollar is a safe haven. It's not, but everybody thinks it is, so I own a lot of U.S. dollars still.
Jim, now whether it is recession or peak of inflation, some would argue that interest rates globally are nearing its peak, at least in the interim. Is it a good time to park cash back to bonds?
Well, cash, it depends on which cash, first of all. If you own the wrong currency, you're going to get ruined. I am not buying bonds. I expect interest rates to go higher over the next few years. I mean, you don't remember, but in 1980, when we had the last inflation, interest rates on short-term treasury bills in the United States were 21%. That's not a typo. Short-term treasury bills were at 21%. It's going to take a lot to kill inflation this time because inflation is worse now. Not this month, not this week, but before this is over, interest rates will go much, much higher.
Jim, the joker in the pack is that Ukraine and Russia are still at a war. Now, there are two assumptions here. If they continue to remain at war, what impact it will have on inflation and commodities? And in next 6 months, if there is a ceasefire, how will that impact commodity prices and underlying demand?
Very good point. If I don't know why this war keeps going. I don't know who's getting anything out of it, neither Russia nor America nor Ukraine. But if it ends or if there's a ceasefire, everything is going to react. Stocks are going to go up a lot, bonds will go up a lot, and oil will go down, grain will go down. But if I were, what I plan to do, if that happens, is to buy grain and to buy commodities, because that will be a buying opportunity.
You've always argued that Chinese markets and the Chinese economy, they have a lot of inertia going for itself. But last 2 years, if you examine the Chinese stock market, the Chinese administrative policy, the Chinese capital market, real estate sector, one is getting a sense that China is speaking out to its growth. What implications do you think that will have on global growth per se?
Well, I get the impression just from reading the press and from ET Now and things like that China is, it has been very restrictive internally for a while, but it seems to me that something is changing and that China is now trying to be more open to the outside world. If that happens, it's certainly going to affect the Chinese economy, but it's going to affect the worldwide economy. I mean, there's been very little travel in China or out of China for 2 or 3 years. The travel industry, tourism everywhere is going to prosper if they really are opening. And it's my view that they are opening up more than they were before.
China comes back in full bloom this year. Do you think it will have serious implications on demand and commodity prices?
Wait, I'm sorry, what?
Now, if China comes back in full bloom, if the restrictions are lifted, if COVID normalizes, is there reason to believe that it could lead to serious price inflation, especially in metals and commodities?
Well, it will add to inflation because whenever there's more demand for something, prices go up. And if prices go up, that's called inflation. And certainly will affect metals, it will affect food, it will affect everything. I mean, China's a gigantic, it's the second largest economy in the world, as you know.
Jim, apart from drinking water in a silver cup and stocking silver and gold in your pocket, what else would you recommend our viewers would do for people who are looking at investing and creating wealth in the medium to long term?
I learned silver from India, by the way. The Indians have staggering amounts of silver, as you well know, and gold. I think India is probably the most important factor in the silver and gold markets anywhere in the world. So this is something else I learned from you. And I do drink out of a silver goblet. It was my mother's goblet, for what that's worth. I'm sorry, I forgot your question. I got so carried away with silver.
Okay. Jim, I remember we had a conversation and you said that for me, it's very simple. I would like to eat rice because I'm bullish on commodities. I would like to buy rice and eat it with silver chopsticks in a silver cup, so to speak. Has that habit changed, Jim?
Well, I still own my silver chopsticks, by the way. Again, I learned about silver from India. When I first went to India, I found silver and gold everywhere, and I learned a lot from India about many things, but especially silver and gold. No, none of that has changed. I am still optimistic because I know that once we have the big rally, inflation is coming back. And when inflation comes, if you own the things that go higher in price, you make money. I don't like inflation. Nobody likes inflation, but politicians are not very smart.
All right, Jim, it's been a pleasure interacting with you. Lots of interesting pearls of wisdom that we've got. Dollar index will go higher, and that's largely on the back of its perception as a safe haven. But he believes that staying focused is more important than diversification. Would buy grain, commodities, not buying bonds. And of course, that view on silver and gold continues Jim says he continues to own commodities. Okay, let's just quickly revisit the markets, and that's what's happening in trade in terms of individual movers. Take a look at Cipla, that stock trading below its 200 daily moving average. You've got something like a National Fertilizer seeing a very smart price volume breakout in trade, up a solid 9%. Aegis Logistics, that stock is active in trade today, and then you've got something like All Cargo Logistics clearly reacting to its numbers. So that stock is down and out in today's trading session, double-digit cut by nearly 11%. Just want to quickly revisit Nykaa as well. A quick look as to how the company is, how the stock is trending. Do remember they said that the Q3 margins have been hit by seasonality and fashion as the category is gaining market share, but the street giving the numbers a thumbs down. Well, let's hear out from another big market voice. And despite the volatility, several opportunities in the market, according to Safir Anand. Here are some of his top holdings in the portfolio that he's bullish on.
I have spoken to you about State Bank of India, spoken to you about ICICI, and they continue to be my top holding. And the others top holdings are, relatively smaller companies. For example, I own a pump company called WPIL, where my entry price was significantly lower. Now, just in last 2 days, the stock is up 40%. Even today, it is limit up. Now, I will have to go back in the evening and see how it has changed the allocation. That is what a dynamic portfolio is. You don't decide the allocation. The market reward decides the allocation, or the market punishing a particular stock decides the allocation. And then you have to revisit your decision to think that was it an error on my part, either of omission or commission. I should have bought more, or I can still buy more, or should I be pruning my stake in some of these companies. So, for example, in pharma, like I exited most of my pharma positions a few months back, and I wrote that I don't see any triggers. I mean, COVID was past, the people are moving on to other businesses, infrastructure is going to be built all over the world. Now, if pharma corrects too significantly and I decide to find an opportunity there, then I will buy it. And if it rewards me, it will become in my top holdings, because that's how it is supposed to be.
Let me phrase my next question slightly differently. One or two large cap stocks where in next 3 years you expect a 50% upside. That's a reasonable estimate for a large cap stock in 3 years. And one or two mid cap stocks where you think in 2 to 2.5 years, they potentially could give you 100 to 150% upside. That's a reasonable time frame for a mid cap stock, considering that you will be taking higher risk. Fill in the blanks, Safir bhai.
See, as far as large caps are concerned, I am open to admit the fact that I do own the large cap banks, and I will continue to be a believer in the fact that some of them may go up by 50%. There is a very big difference when it comes to, for example, a large cap stock which is very capital intensive, and very different when it comes to a stock which is sitting on capital waiting to be allocated. So I'm hoping that India, as long as India does well, a lot of these banks will have very good offtakes. And also the level of innovation that has happened between them and several collaborative business models that they're entering into is very interesting. So much so that even banks that I traditionally did not like, which could have been, some of the other PSU banks, not the primary ones like an SBI or some of the other private sector banks, they're also showing numbers that are talking. So it's like everybody in the class is doing well. You're literally sitting in an IM or an IIT class right now. As far as mid caps are concerned, I think 50% returns is a very reasonable expectation in the next 3 years. You have to look at the longevity of a sector. For example, there are companies that have undergone capex during the last 1 or 2 years. And this capex has come when the rate of interest is high. It has come when the world has been disrupted. It has come when the offtake and the margins were all squeezed. They will become beneficiaries, and some of these will also include chemical names. Some of these will include manufacturing names. Some of these will include cement names. Cement was just one example. It's not typically a sector that I track too much. So I would rather have the patience, logistics, for example, I would rather have the patience to continue buying in these sectors, because if in 3 years I can make 50% or more, or perhaps even double my money, I would have done very well as an investor. And if I have not, then my rationale of why I invested must be tested. And that rationale is not tested by a quarterly result. It is tested when the business models lose the potential to grow.
So we've discussed the theory. Now the practical part, the names of mid-cap stocks.
Like I told you, I'm not SEBI registered. I don't know what extent I can talk about, but okay, what I'm doing personally, I'll see. Like, I do believe that in the logistics sector, companies like Blue Dart that are expanding rapidly, they are buying planes. both Blue Dart and their parent DHL are talking about a very large capex. They're a technology leader. They're a market leader. The market all of a sudden reacts to a slowdown that happens because ATF fuels. And then one day Amazon decides to announce 2 planes, so the market reacts. The same day DHL announced 3 planes, or the next day nobody cares. So you have to look at opportunities. You have to look at the cash that these businesses generate, the kind of dividends that they offer, their parentage, their lineage. Similarly, TCI Express, which a stock that is corrected in the same sector, look at what the company's done. Of course, the stock is still more than double from the level at which I entered, but look at what the company is doing. They're right now going through a buyback. So the logistics sector is telling you, and even companies that I don't own there, like a Mahindra Logistic or another logistic company that I do own, Aegis Logistic, the commentary seem to suggest that there is a lot of work that is happening there. Even smaller players are registering. So I will be a believer there, at least on the long term, and I do believe that the sector is a sunrise sector in India. So that's one. And the second are some of these amine companies that are now have corrected because they were fair to come on channels like yours and tell the world that, look, we are facing issues with APIs.
Gautam Shah joins us now. Let's connect with him and understand that which way he feels markets are likely to move, and when will we come out of this range, Gautam?
Good morning, Nikunj. Well, I think the markets haven't displayed great characteristics in the last many weeks, I should say. I think since the middle of December. And I think we've had these pauses from time to time. These pauses have looked more like distribution than consolidation. We have been maintaining a cautious stroke bearish stance for a while now. And I think there hasn't been any evidence on the table to suggest that we are turning around and we are going to reverse and start doing well once again. Because I think the market has really lost its leadership. The momentum on the upside is not there. Every single time the Nifty approaches an important resistance, instead of that urge to actually break out, it just finds selling pressure. And this has happened repeatedly in the recent past. So currently, I think the battle lines are clearly drawn, 17,650 on the downside, 18,050 on the upside. Till we then don't get past this band, I don't think anything special is likely to play out. And the fact that most of the developments or the events that markets were discounting, are now in the price. So whether it's the Adani fiasco, whether it's the budget, the earnings, all of it is now in the price. And therefore, the market does not have any event to look forward to. However, having said that, I don't think this is going to carry on for too long, because currently the price action has been within the swing of the budget day. It was a 600-point swing that day. And since then, the Nifty has been stuck in that band. So till we don't get past that swing, I don't think we are going to resolve into a trend. But my feel looking at the charts is that eventually the markets will break down and see lower levels. And therefore, we maintain a cautious stance.
Let me just look at the other side of the argument, glass half full, or maybe like a compulsible argument. Whatever could go wrong has gone wrong this year. Adani fiasco, haywire movement in the currency, comeback in inflation, commodity prices going here and there, and excruciating selling by FIs. Yet Nifty has not broken below the range. Isn't that a bullish argument which has some validity?
Yeah, it's a good way to look at things. But, in financial markets, you never say never. I think there is always some excuse for the markets to fall. When we first started looking at the markets differently in late December, you didn't know what excuse is going to hit us. And then it hit us, obviously, in the Adani fiasco. And I think, let's not forget, in the global equity basket, India has been one of the worst performing markets in the world, sadly enough, in the last 2.5 months. This is a tag that we've not seen in 3 years. And therefore, clearly, there is something wrong somewhere. The point that you made makes sense. But when I look at the sum of the parts argument, if I look at the index heavyweights, I don't see too many names that can actually propel this market past 18,050, because banks are in a difficult space. Reliance is not doing too well. IT cannot, carry the burden for too long. Stocks like ITC and L&T, and Bhartis of the world have just risen too much, and they don't have the momentum to, scale greater heights. So the sum of the parts calculation tells me that the downside potential is far greater than the upside. And as a technician, as I said, look at the price action, the momentum and the participation, that's been quite negative. The only bright spot is the mid caps and small caps, but even there we are getting a little concerned now.
Little concern when it comes to the mid-cap space, but what's your view, Gautam, when it comes to the entire banking index? Because that's been the clear underperformer this year with a cut of what, around 4% versus Nifty, which is down around 1.5–2%. Do you see a reversal soon in the bank Nifty?
I don't think so. I think second half of last year, we saw a phenomenal rally on the bank Nifty. I think we had levels of 44, 44, 500. It was great going. Everything participated. And things just changed completely in the last 1.5 months. I think there is a lot more room to fall. Our initial target was around 39,600, which was tested. Anybody looking at the charts would know that it was the important support. From there, we've seen a bit of a bounce. But the bank Nifty, once again, if you look at the last 5-6 days, it's not been able to take out that level of 42,000. So till that number does not get taken out, we would remain bearish. And we want to believe that eventually 39,600 will break, leading to much lower levels. Again, if you look at the leadership, look at ICICI Bank and SBI, two of the poster boys of the last 2 years, they have stopped outperforming. And HDFC Bank as a stock has just got range bound and it's just languishing just below lifetime highs. Axis Bank, IndusInd Bank, and the PSU banks, obviously the BOBs and the Canara banks of the world, they all have negative setups. So I think banks and Reliance put together would be the reason for the market to break down if it were to happen sometime in the near term.
And Reliance would be responsible. But, interestingly, it's the IT index that has had a fairly decent year with that outperformance. Are you of the view that there is still, that index is still a buying opportunity?
Indeed. So smart money has to move somewhere. There has to be some place to hide at the marketplace. And that is IT. I think the price action has been excellent, while the Nifty has found it very difficult to sustain near resistance. If you look at the IT index, every time it's come close to support levels, we've seen a lovely rebound. I mean, look at what HCL Tech has done, Infosys, TCS, persistent in the mid-cap space, and many, many stocks in the entire IT basket, I think are setting up very well. So while there is potential for the Nifty to actually fall 10% from here, there's potential for the IT index to rise 10%. So that's how we have shuffled our stance, and we've been recommending our subscribers to be topped up in IT, capital goods, auto, and PSU. These are the 4 baskets that we like. Everything else is an avoid.
You approach Adani group of stocks. They are volatile and they are giving you two-way moves. If you get them right, it's a serious chance to make money.
Was that question for me?
That's right. How would you approach Adani group of stocks?
Well, I think it's got a little popular and it's moved deep into retail now. So we are actually avoiding the Adani group now. I think last couple of years was a great money-making opportunity on the long side. Last couple of months was a great opportunity on the short side. It's all played out. Now it's got into a very noisy kind of a phase, wherein there is no trend. Rallies are getting sold into, dips are getting bought into because some people feel that it's a little overdone, which is also a fair argument. So in this, I don't want to be standing in between, rather stay on the fence and let Adani stocks do what they want to do. So I'm not a buyer, nor am I a seller at high levels. It's just an ignore for me. I think there are much, much better pockets and bets in the market where you are getting a lot of momentum. I'd rather focus there.
Purely on the charts, without getting into a buy or a sell recommendation here, if you have to analyze the charts of the top 3 or 4 Adani group of stocks, do you think the panic lows what were made closer to the first week of Feb, do you think those panic lows could be revisited or they will remain intact?
See, first things first, it's already been a very large fall, right? I mean, and it's been very fast. In a matter of 6 weeks, stocks have fallen 40, 50, 60%, 70%. Now that's large by all standards. So the panic lows, I think, will hold for some time. But if my overall market view is negative and I believe that eventually the indices will see a breakdown, I think at some point of time, the recent lows could be retested and maybe even broken by a small margin. So I don't see clear-cut bottoming signs. If at all, I would still look at an Ambuja where I feel the recent lows might still hold out. So I would still look at that stock. But everything apart from Ambuja, I think it's still too early to say that the worst is over.
In a bit of a cautious stance when it comes to Adani group of companies in the market as a whole, wherein Gautam has a bit of a negative bias. But Gautam, you're quite positive when it comes to the auto space rise, right? Talk to us about the top bets there.
Yeah, autos have done quite well. I think in a difficult market environment, they held out really well. Look at M&M, how it stood out. Maruti has been respecting support levels. Tata Motors has rebounded from a long-term support. And I think all of these 3 stocks which I mentioned should do well, and it should propel the auto index to new lifetime highs. If I'm not wrong, our working target has all along been about 15,000. So that's another 10-12% from where the index is right now. And somehow they've just gone negative beta. Every time markets fall, somehow there is a lot of strength in the auto space. Fundamentally, people talk about input prices and the impact that could have, on the entire basket of stocks. But as a technician, I see a lot of relative strength, because when you divide the auto index, divide by the Nifty, you get a sense that this is one of the few sectors in the market which is in an uptrend. So I think this is going to continue. And the 3 or 4 stocks that I mentioned, I would focus there. I would not go to the other side. I would not go to Hero or a Bajaj, because there I think there are still problems on the charts, and fundamentally is what I hear. But the other 3 stocks which I mentioned, I'm more convinced.
Gautam, every year we get a strong sectoral rotation. For example, I'm just putting in context for the benefit of our viewers. 2021, it was all about IT and fintech. Then the good old value trade made a comeback. The 2002 belonged to NTPC, ITC, and perhaps Coal India. For 2022, if markets have to rotate, are you making a case that it could be autos? Because autos, again, have been almost in a 4 to 5 year kind of a sideways market.
Yes, I think for this year, it has the potential to be a theme that could stay strong the entire year. But along with auto, I definitely want to add IT. I think that will be a bigger theme. That will be a better place to hide. And the third theme, which I've really liked and I've spoken about it every single time on your channel, is capital goods. I think I still love the way the entire setup is. L&T has been our favorite for a long time now. And I think it's going to do much bigger things once the market stabilizes. And, and not just L&T, Siemens, Cummins India, ABB, lovely long-term setups, great fundamentals. They're all sinking in beautifully. So for this year, as you rightly pointed out, auto, IT, capital goods, looks like the rotation has gone into these names.
For those who bought pharma, with the exception of Sun Pharma, which has given you decent returns, Lupin has been a disaster, Natco has been a disaster. People are still feeling the heat of the sell-off in DVs. Is pharma in a tough spot?
I think it's close to turning the corner, Nikunj. I know it might be a slightly contrarian call, but when we look at the charts in the last couple of weeks, we just get the feel that the selling climax has already played out. And I think that selling climax was triggered by DV's lab. If you look at some of the other names like an Alchem or even a Lupin or a Dr. Reddy's, I think the downside is little, maybe 3 to 5%, and the upside potential is 10, 15, 20%. So for aggressive traders and aggressive investors who don't mind that patience, who don't mind to take that contrarian call, I think pharma is a space where you can start nibbling into. Stay with the top names, stay with Alchem, great earnings, great track record, stay with Dr. Reddy's, Sun Pharma, Cipla, obviously. And if you're stuck with these 4 and if the pharma index does turn, I'm pretty confident that it will do well. So it's a sector that we are closely following, and we have a contra view on the positive side.
Those were a lot of names that you've thrown up. Thank you so much, Gautam, for being so generous. Maybe you're showing us some love on Valentine's Day. And Nikunj, I know a way that you can also spread some love in the office. Their pizzas from Domino's are shaped in a heart. So we're quite hungry already.
Well, pizzas are something which they say it's junk food, and it's for you girls to
We're
decide
ready
whether there's an office hour. I think you're on a keto diet or a vegan diet.
Absolutely no diets today.
And take a look at the flavors and the what they've introduced on Valentine's Day. They're available in 2 flavors, tomato and pepperoni, so one for each of us, and 299 rupees each. It's actually available across Bangalore, Delhi, Mumbai, Chennai, and Kolkata. So
And 30 minutes later, pizza free.
And it's not too pricey, right? 300 rupees, I mean. Like,
and everyone in my ears also saying we want pizza, Patricia, Trevor, everyone. So
I hear that.
okay, so that's what's happening when it comes to Domino's. No love on the markets for now. It's absolutely sideways. Yes, there are some individual names that stand out within the broader universe. So like a Dishman Carbogen or an Oil India. Those are some of the names that are abuzz. Quick break. Be right back as we connect with the management of Mrs. Bector Foods.
Welcome back. Well, 17,825 is where the Nifty is at, a gain of almost 53 points. It's the broader market which is also holding up today, so the advance decline ratio is not as bad as we saw it yesterday, and a lot of result reactions coming in. In fact, since we are talking about result reactions, let's also pull up the counter of Mrs. Bector's Food. It was a decent set coming in, with the revenue growing by around 40%, the profitability jumped by as much as 80%, and the margins too have improved substantially on a year-on-year basis. Let's welcome on board Manu Talwar, the Chief Executive Officer at Mrs. Bector's Food Specialities as well. Hi, thank you so much for joining us this morning. We have seen a revenue growth of around 40% in the biscuit segments. Could you talk to us about how much of it was volume-led and what part of it was actually price-led?
So primarily, it was a largely volume-led. We have taken a price of approximately 10% and largely it's an effort of driving our distribution and growing through volume, premiumization. These are the two key drivers other than the price, which was approximately 10% and largely led by the huge effort made in terms of driving our distribution.
So your EBITDA margins, which have gone to about 14% at a time when commodity inflation generally has been strong, what happens next? If prices come down, will you be able to improve the margins further?
You see, what we are targeting and which we have said earlier to our investor community is that our first target is to consistently deliver over next few quarters 13 to 14% EBITDA, right? And as far as the commodity prices are concerned, yes, there has been some bit of a softening, but it has not entirely mellowed down. But yes, coming back to the margin, target is to deliver 14% over the next few quarters before we make the next leap jump moving up from 14%.
Good morning. Wanted to also understand what your outlook is when it comes to your EBITDA margins as well, because a near-term target of about 14% had been spoken about, which has already been achieved in Q3. So now will there be revisions on the upside when it comes to margins?
As I said just before that, first objective or first target of the company is to kind of consistently deliver this 14% over next few quarters. And then obviously we will make a journey from 14 to 15%, right? But yes, the first target is to consistently deliver around 14% of EBITDA. As you know that we are growing and we are also investing in our growth. So we're investing in our S&D, which is sales and distribution. We're investing in our marketing. So alongside this investment in the growth, we are very conscious of margin as much as we are conscious of our revenues. So that would be the journey that stay around the consistent delivering around 14% EBITDA for the next few quarters, and then move up and do a journey to 15% EBITDA.
That's how the EBITDA margin, trajectory is likely to shape up. But Mr. Talwar, also wanted your sense if you're worried about the threat of increased competition, because we were just listening into the commentary coming in from Britannia as well, and they are talking about how they want to expand their positioning when it comes to the North Indian and Western belt as well. Is this something that can impact the competitive intensity and then hence the pricing and margins?
You see, the biscuit market and the landscape is fairly large, right? And with our aggressive growth in distribution. So what we are planning when we started this financial year, our direct reach was around 160,000 outlets, right? And we had taken a journey and a target to get to doubling these outlets by March of 24, and we are very much on that path. So we're fairly confident. We have invested in the sales front line. So we have invested in the front line, strengthened the front line to approximately 850 people. We have invested in FSA, which is Salesforce automation, to assist our sales force to help them improve their own performance. We are in the process of implementing both DMS with our distributors, right? And we have also invested in the building sales capability and designed a sales training program, which is under execution to improve the build. So with enough going in the input KPIs, we're very confident that we should be able to drive our volumes and revenue up in high teens in the coming quarters.
let's understand that what kind of institutional growth you expect going forward. Let's say in your bakery business. One is the B2C business, which is growing because you're increasing your distribution, your brand is expanding. But what about the institutional business, which is always a tough business, highly competitive and very price conscious?
What we see in the market, that institutional business is also growing fairly well. It is growing in high teens, and that's what our expectation is for the next few quarters. Because as the consumption story of India remains really strong, and the QSR business in India is kind of growing very, very well. So we do expect that even institutional business should continue to grow in teens.
Because the pie of the bakery business and the biscuit business is expanding, or this is pure market share gain?
No, it's expanding. It's a market which is expanding because we already in the QSR business have a very high share. So it's primarily coming through the market expansion.
Your plan in place to compete with the heavyweights, for example, Britannia, ITC, even Patanjali now has become very aggressive in the bakery market. I mean, there are disruptions which are clearly happening. The variety of biscuits and the variety of breads are increasing. So what is your plan in place to have an edge?
So our edge primarily in the bakery side, which you're talking about, has been our premium product and the quality of the product. And the innovation which we are doing and introducing new product lines in this category. So we're fairly confident, and English Oven brand, which is our bakery B2C brand, is kind of very widely accepted by the consumer. So we felt fairly confident that with the expansion of our distribution and with the product innovation, we should be able to continue a lead in the bakery segment.
Okay, Mr. Talwar, we'll let you go on that note. Thank you so much for joining us this morning. But talking about the markets, it's the stock of All Cargo Logistics, which is actually taking it on the chin. It opened with a cut of around 10%, and now that's only intensified because the stock is now down as much as 19%. The results were, of course, disappointing, and that's the reaction that you're seeing as far as that stock goes. On the gaining side, however, Nishal was talking about how he's positive on Triveni Turbine. That seems to have had an impact as well, because that stock is holding up with a gain of around 6%. Triveni Turbine is the stock that I'm talking about. Cyient is another mid-cap IT name which is doing its bid 4% higher. And surprisingly, you have UPL today, which is actually quite excited. So a 4% uptick coming in on UPL, and ABB, which was reacting negatively to the fact that there could be increased competition from its global peers yesterday, is holding up today. So we are seeing a movement of around 2.5% on that particular counter as well. And sectorally speaking, it's pretty much IT which is in favor today. So L&T Tech, Persistent, HCL Tech, LTI Mindtree, these are the counters which are holding up in the green. But shifting focus as we head towards the end of the earnings season, let's take a look at how the export-focused cyclicals have performed in the quarter gone by. My colleague Sharad is joining us to decode all of that for us.
Well, in focus, we are having Apollo Hospitals, the country's one of the largest medical and the hospital chain is in focus, and it's expected to come in with a muted set of numbers in this third quarter. And do remember, it's a seasonally weak quarter. Now, the important thing is the headline numbers. If we check, the revenue is expected to go up almost 14% on a year-on-year basis to the northwards of rupees 4,150 crore rupees. But do remember that the EBITDA numbers, the margins, they are expected to contract, and they are going to come between 15 to 18% of contraction on a year-on-year basis. And if we look on a sequentially basis also, that's expected to fall in lower teens. Now, apart from this, what stands apart is the sales is expected to come into low single digits because of the seasonality. And if we look at the hospital business as well, especially the mature hospitals are expected to outperform the new business, and they're expected to grow in the range of almost 10% on a year-on-year basis. Apart from the hospital business, the occupancy is also expected to moderate, coming in from 68% to expected rate of almost 64%. The pharma distribution, however, if you see, that top line is expected to go up by almost 20% on a year-on-year basis, while for the AHL business is expected to be on a muted numbers. Now, apart from this, what are the margins which are expected? And there are three different divisions. Of course, for 24% is expected for the existing existing hospitals, while 16.5% is coming for the new hospitals. 7% expectation of margins is coming in for the pharmacy business, and this doesn't include the 24/7 cost. But importantly, there are two important factors to watch out for the earnings, and the first one being is the traction in the services seen in the 24/7 pharmacy services, and how is the progress happening when they are diluting their stake in HealthCo.
Okay, Sharad there giving us the expectations from Apollo Hospitals this quarter. We'll be closely watching out for their earnings. Time then for Chartbusters. So let's reconnect with Naresh Mirani. And Naresh, we were just talking about mid-cap IT really being in a sweet spot this morning. And you've cherry-picked LTIMindtree?
So LTIMindtree has not made as much as a bounce as the rest of the IT names. And the stock has corrected from that 7,000, 7,500 mark all the way to 4,000. That is where it made a bottom in May and July. And the December bottoms are around 4,200, where it has made a strong base. And now has started making higher tops and higher bottom formations. So it's a risk-reward trade wherein it's with a buy with a strict stop loss at 45.50. Expected to go towards that October-November high of 5,100, 5,200. So it's a trade with the next 2 to 4 days or 2 to 3 weeks max, wherein I would expect it to slowly go towards 5,100, 5,200, but would keep a strict stop loss at 45.50.
Okay, so that's the trade coming in as far as LTIMindtree is concerned. But Naresh, what about your other stock recommendation? What's catching your attention this morning?
So it's only the heavyweights which are showing some bit of a recovery. So first is the buy in Reliance Industries trying to recover from that 2,300 mark. And this could go towards 2,450, a stop loss at 2,300. Second is a buy in L&T, a clear outperformer, a stop loss at 2,150 and a target price of 2,300.
Okay, there you have it. Some top recommendations that Naresh is flagging off. Reliance Industries and L&T, they find favor. But let's get a move on then and put the spotlight on Eicher Motors, all set to deliver its numbers today. What's going to be the expectation when it comes to Royal Enfield's volumes, the margin uptake? Is that going to be on the cards? Vinny is here to walk us through the ET Now poll. Vinny.
So Eicher Motors is expected to post its numbers. In terms of revenue, we are expecting a mild revenue growth of only 2% on a quarter-on-quarter basis. Year-on-year basis, it will be a 25% growth. While in terms of the profits, we are expecting a 12% growth in terms of profits on a quarter-on-quarter basis, while margins are also expected to come in at 24.6% versus last quarter, what it was 23.3%. So an expansion in terms of margins on a quarter-on-quarter basis is what we're expecting. Margins, so operating performance is expected to see an uptick coming in there. Now, what are the factors that that come in for Royal Enfield? So in Royal Enfield, volumes are up by around 30% YOY and 6.6% QOQ. Mainly, the volume growth is expected to be led by the healthy response in the new Hunters launch, and easing of the chip shortage is something that is supporting the will support the volume growth for RE as well. Overall, export volumes also has seen a growth of just 2% on a year-on-year basis, owing to the slowdown in the EU business and EU region, and obviously amid the rising inflation, that was a concern, as well as seasonality, all that came into play for RE. Now, other factors in terms of margins, operating leverage is there for the Royal Enfield margins. The raw material tailwinds are a factor as well. Cost control measures as well as the offset of high mix of Hunter is something that is keeping the margins in check as well. In terms of VEC, margins are likely to improve, led by the higher CV volumes and softening RM as well. And expected to report, the VECV segment is expected to report a EBITDA margin of around 7% this quarter. So watch out for the new launches that they have, sales outlook, especially in overseas market, views on the EV bike as well as the product mix are some of the factors that we're keeping an eye out on.
Thanks, Vinny, for that. But let's go across back to Sharad. He's with us to talk to us about, as we come to the end of the earnings season, what the export-focused cyclicals have actually performed in the quarter gone by. Sharad, tell us those details as well.
Well, yes, in this list, we pick out the weak performances actually been recorded by the cyclical stocks having global exposure. In the first table we see is, of course, two stocks coming in from the Tata Group. First is being Tata Steel. Of course, the numbers were impacted because of the European operations as well. However, the management commentary did state that the Q4 would be better. Even the Tata Motors China sales, especially the JLR sales, that they were actually impacted. Now, do remember these sales actually globally account for more than 40% for both of the Tata Group stocks, and the numbers, if we see for the Q3 numbers, were on the weaker side. Apart from this, even RK Forgings were there, where they come out with the inline set of numbers with an exposure coming in towards the North America and the European side, while for UPL, however, the numbers were quite decent because the higher exposure was there in the LATAM industry. But do remember, this is a cyclical play. Apart from this, there are stocks such as Hindalco, where its arm Novelis reported a weaker set of numbers as well, and that contributes almost 65% to the total revenues. Balkrishna Industries, yesterday the stock did crack and on a higher exposure coming from Europe, and the demand outlook was weak, and because of that the stock fell down. Sharda Cropchem also suffered huge losses in terms of forex for the last 2 quarters as their billings come in euros. And lastly, Sumitomo Chemical also reported a weak set of numbers with almost a 76% exposure to the global revenues. But the main important question is, what are the main triggers for it? Of course, the first one being the rising interest rates, a demand scenario which is coming into the recession phase, and this actually applies for the developed markets such as America and North America. And do remember, there are supply chain constraints happening due to COVID-19 of locking, unlocking in China, which is impacting the global trade as well, and also companies having exposure to China from India. And lastly, also the agrochemical stocks, they are in focus, and of course the favorable numbers are coming in from LATAM regions. But if we talk about the European exposure, that is still having a demand issue.
All right, thanks very much, Sharad. They're giving us details on how individual companies are impacted largely on the back of their export exposure. On that note, we take a very short break. Stay with us, lots more lined up.